All right, let's kick off. Thank you to everyone who's joined already. We've got a few more people coming on board, but I think we're ready to start. So welcome to today's webinar, the Business Risk Review, looking at results for July 2021 just gone. As always, there is plenty happening. Of course, we had that big lockdown that came into effect just before July started. So July is certainly a good bellwether for what is going on out there. As always, CreditorWatch product suite up here. We have everything for you from a credit risk management perspective. Onboard customers with an online credit application instead of using an old school PDF or paper-based application form. You can set up your monitoring and alerts on all of your customers. You can run credit reports, credit risk scores, payment ratings, understand how people pay their bills before getting into business with them. And of course, we have the likes of API integration and PPSR registrations as well. For more information, please contact us or go to creditorwatch.com.au. There's a huge amount of information on there, whether you're a small business or an enterprise. Some key highlights. I like to show this particular slide because it gives you a really good understanding of, what does CreditorWatch capture from a data perspective? Where is it coming from? How much of it is coming into their bureau? The fact is there's a huge amount of data coming from dozens of sources, public, private, and proprietary. Government data sources, of course, like APSA, ASIC, the Australian Business Register, no shortage of them, and the courts too. Over 50,000 customers across Australia providing information as well, which is extremely relevant, predictive, and accurate. Ultimately, that data that is coming through allows us to make predictions, but also to show you what has happened, in this case, in July, and give you a bit of prediction as to what we think will be happening going forward. So a quick agenda. What is the Business Risk Review? I think most people know what that is. You get plenty of insights from the email and the landing page that you sign up on. And if you've come to this before, you've seen me talk about it every single time. Big things, questions. Please do ask questions. We're getting a lot of questions in our webinars lately, which is fantastic news. We like to be able to answer those. I can't get to them while I'm in the webinar. We will obviously come back to you thereafter. And then the rest of the agenda, of course, will be going through the normal things that we look at. We've got our economic insights that we kick off with now. Fortunately, we've got Harley Dale as our chief economist who provides these insights for me before I do the business risk review. And then, of course, we start to look at administrations, credit inquiries, payment defaults, court actions, all of those key predictive indicators, but also really good to look at in a historical sense to see how did July perform versus June, for example, or previous years. And of course, we've started to bring in 2019 numbers so we can actually compare not just COVID years of 20 and 21, but also how it's all comparing to pre-COVID years in 2019. So the Business Risk Review, there you have it, a huge amount of data coming from various sources, allows us to talk about what we're seeing and what we expect to see. An important stat here, of course, GDP, quarterly growth, tracking along historically very well. If you go all the way back to March 2013, and then bang, obviously hammered in that first quarter. Late March is ultimately where COVID really kicked in and kicked in hard enough, despite the fact that it was very late in the quarter, to cause a negative dip, big dip, of course, in June, and then we have recovered. The question is, what will the next quarter look like? How will it be affected, and by how much it will be affected, of course, and then looking at the quarters thereafter. It would be great to get this GDP, I think, on a monthly basis rather than a quarterly basis. I think one thing we've learned through all of this is data is extremely valuable, but it also needs to be timely. Having to wait 3-4 months for something simply doesn't get the cut through that, getting updates on a daily basis, in which case, if you're in New South Wales, you hang out for the Premier's update at 11 o'clock every day. But of course, if we can get stats on a weekly or even monthly basis, that is extremely timely and valuable. So economic insights, as I said, our chief economist, Harley Dale, provides these through to me before the webinar, which is great. The Australian economy obviously grew a lot faster over the first half of this year than anyone anticipated. I always say that where we found ourselves in sort of May, June of this calendar year, certainly wasn't on the best case scenario of even the most optimistic economist. If we were to go back to, May, June in 2020, when we were really in the depths of COVID, and Victoria was about to go into its really extended lockdown as well. So we're certainly fighting off a very strong base, a high base. Doesn't make it easier for business owners and employees and people in general out there. However, I think, to keep in the back of your mind is that we will have a really nice rebound. We rebounded extremely well out of 2020, much better than anyone anticipated or expected, and that will certainly happen in New South Wales and Queensland and Victoria. All the states will be powering out of COVID and lockdowns when they finally come. That's obviously the big question mark, is when is that going to happen? And ultimately, no one can really answer that at the moment, unfortunately. And in the recent survey we ran to our customers, the number one issue that came up about the future was the uncertainty about the future. They want to be able to understand what goalpost, what date are they planning towards? When are they expected to get out of this? Once they know that, even if it's 12 months from now, they can start to understand how they're going to invest, how they're going to grow, how they're going to hire people, they're going to buy new technology, stock, etc. It's really important. So uncertainty is the number one cause for concern for certainly our customers, and they are all Australian creditors. We've heard today as well, obviously, extended lockdown in regional New South Wales, which just puts more pressure on business. It'll put more pressure on the government as well, and it'll certainly put more pressure on state and federal purses as they look to support businesses through this for an extended period of time. As I said, certainly started from a strong point. In June, we were firing, and then obviously these extended lockdowns have hit very quickly. It will stymie growth, it will hurt unemployment, and SMEs will ultimately be the ones that are impacted the most. Interest rates are going to remain low for the foreseeable future. The RBA has doubled down, tripled down on this, despite plenty of discussion and media attention on it. And even with some of the banks starting to adjust their variable rates, the fact is that they will not be changing interest rates for the foreseeable future, which is great news. And I think the fact that we've gone back into lockdown in a number of those eastern states will certainly strengthen their position there, which is great because it just means borrowing costs remain low, which is really important regardless of whether you are a consumer or a commercial entity. The unemployment rate, of course, was falling very fast, faster than anyone expected, which is a really, really good positive, great for the economy, great for consumer confidence as well, good for people just in general. However, these lockdowns, particularly the ones in New South Wales, we will certainly see a snapback up in the unemployment rate when they start to release those figures. Recent lockdowns, of course, not really, in my opinion, well anticipated. Seemed like it took the governments a little bit longer than it really should have to roll out stimulus and support packages when everyone was talking about the fact that COVID can come about very quickly. It seemed like it took everyone by surprise, unfortunately. Hopefully we've learned from that, and hopefully we don't have to endure anything like this as the vaccination rate increases. From a CreditorWatch data perspective, there's a number of key industries that we're really keeping an eye on, and I will touch on those a little bit later when we look at the probability of default across all of the industries. But of course, construction has stolen a lot of the limelight over the last sort of 4 to 6 weeks. Big amount of media that it grabbed for the 2-week lockdown that it went through. Got to feel sorry for retail and hospitality who have endured lockdowns for probably 10 out of the last 16 months or so at varying rates across the various states. However, we know that construction is a huge mover and a powerful GDP contributor in Australia, so it's certainly garnered a lot of media attention. The fact that they've come out of the 2-week lockdown is great, but there's still significant restrictions on it, so they haven't got back to the normal 100% output that they had been tracking along. So let's get into the numbers itself. This is, of course, the positive. This is what I like to lead with. Credit inquiries in July. We've seen another increase versus June, but also versus July last year, 26% increase. Credit inquiries, as I've been calling them, the heartbeat of trade. That is, companies, debtors applying for credit, but also creditors assessing credit for companies as well. And that's across trade credit and finance. Two is a really positive that we see businesses getting on with it, still continuing to trade as best as they can, despite the lockdowns. And we like to see that continue in the current vein. Payment defaults, the big one that people have been asking about. So just to recap, the last few months, April, May, June, we had seen continued increases, not huge ones, not ones to be concerned about, but really it was showing us that we'd moved away from the safe harbor and JobKeeper synthetic environment that we've been living in. The economy was getting back to normal, business conditions were returning to sort of almost pre-COVID levels, and certainly from a feel perspective, they were returning to those levels. And that meant that businesses were starting to get back into their normal collection rhythms, and they were starting to feel that, hey, if you're not paying your bills, it's not necessarily COVID related. We're going to start registering defaults against those companies that aren't paying bills. So we saw that increase, a sustained increase, certainly not back up to where we were pre-COVID in 2019 months, but we were heading back up there as we expected. But as we know, when lockdowns come about, we see those defaults actually dissipate, reduce, as Australian creditors are quite sympathetic to their customers' situations that they find themselves in. So as a result, if you look at that July to June 21, we've seen a 20% reduction. It's a big, big drop. So business owners stop registering defaults, and they obviously will look to take stock back, put debtors on payment plans, or just sit tight and see how debtors can actually pay, and whether there's any trade going on in their specific industry. If we compare it to July 2020, it's down by 23%. And if we compare back to July 2019, it's down by 48%. Now, again, we probably will see somewhat of a plateau in these defaults, particularly in New South Wales. Once we come out of lockdown, we will then start to see that, I think, slow, sustained increase back up to pre-COVID levels. But we don't expect to get back to those levels until probably the middle of next calendar year, so June next year. Probability of default. So coming back to and linking to defaults. This is a slide or a graph that we've been showing on quite a regular basis. There's a few surprises in here, and then there's a few expectations that I think everyone expected to see. So of course, accommodation and food services, no real surprise there. Certainly the most risky industry through the whole of COVID, unfortunately, doing very tough, very hard to make money when you can't have people sitting in your restaurants and your cafes. You don't have tourists coming into your hotels. You don't have people, Aussie citizens, traveling around, to even regional or local state-based areas. So we've seen that come off a little bit, but still up near that 6% mark. Transport, postal, and warehousing, number 2 there, no big change. Admin and support services, we see a lot of businesses bring those services that they'd usually outsource back in-house, so that puts pressure on that industry. Information, media, and telecommunications, not a lot of advertising going on out there. Smaller publishers being put under a lot of pressure as companies, pull back on their advertising dollars. If we jump to retail and construction, probably a little bit of a surprise for me. I thought that they would be a little bit further up, but retail have been fairly consistent around that 4.5%, and we haven't seen a big increase at all from construction. So it will be interesting to see the August numbers. Hopefully that 2-week blip was just that. It was a blip. They were prepared for it. Companies could shoulder the loss of income, and then they could move forward and get back on with it, which would be a real positive. No other big surprises here, other than probably arts and recreation services all the way down the bottom. or at the top of the graph, I should say. Obviously, people not going out to arts-related events, for example. So certainly want to keep an eye on too. Looking at court actions, I think this graph is a fairly good indicator of how the different states are operating. And the fact is, WA has seen another increase. They are almost back to pre-COVID levels. They are trading normally in the protected state of WA that they are over there. Been very fortunate, and also I guess they would say well managed from a COVID safe perspective. New South Wales, Vic, Queensland, big drops. We know that lockdowns in particular play havoc with court actions. The other big thing to remember is, like administrations, which is our next slide, the ATO and the banks are the biggest creditors in Australia, and they are the ones who generate the most court actions and also administrations. And they're certainly still on Team Australia bandwagon. They're not into that normal collection rhythm where they get to the end of a collection cycle and the next final step is to wind up a company, put them into administration, take them to court, that sort of thing. So as a result, we see court numbers well down on not just 2020 numbers, but also 2019, almost 60% down. So until those two big creditors start getting back into their normal rhythms, we won't see a big increase. Similarly, we feel the same thing with administration. So we've seen administrations again drop away in July after starting to climb back up. So if you remember, June figures were actually above 2020 figures, still well down on 2019. And we were seeing that sustained increase really from Feb onwards. But we've seen the lockdowns, as we've seen in 2020, lockdowns happen and we see administrations fall away. So the prediction for the coming months will be that continues. We see a very sort of flat line of administrations, maybe a couple of blips up and down, but until we get out of lockdowns, we get back into normal collection and insolvency rhythms, we certainly won't see sustained increases in those, and we certainly won't see a return to those pre-COVID numbers that we expect to see in 2019, which is a sort of high 700s, if not 800, 850 plus from a monthly administration perspective across the nation. Having a look at state by state, you can see they're all following similar curves, except for Queensland there. Obviously, they had a jump compared to 2020, which I want to say is a good thing to see, but it's a natural thing to see. Capitalism obviously relies on failure. Otherwise, if there's no failure, well, there's no real incentive to pay your bills at all, is there? So we need to see administrations at the end of the day, and we need to see those move back towards pre-COVID numbers. So I'll just jump in really quickly and see if there are any questions. Sorry, I can't find my cursor there. Here we go. No questions from anyone, no problem, that is fine. I will then run the normal poll. For those of you who would like to be contacted, it's a good opportunity to get on the front foot by doing this poll. Would you like to be contacted? Yes, great. No, don't be shy, that's fine, I won't be insulted. Give that another few seconds, give you the chance to vote. So thank you for that. So yes, I think we still live in that sort of upside down world where, lockdowns and pressure on businesses should really spell an increase in administrations and court actions and payment defaults. But as we saw through 2020 and the various lockdowns along the way, that's simply not the case. And we're seeing that again, that those numbers generally drop and then they have to work their way back up to where they were before these lockdowns happened. The other thing to take away is the fact that, CreditorWatch is seeing payment times, coming back to sort of normal levels pre-lockdown. We then see, businesses close their purse strings and hoard cash in order to protect themselves from the unknown as to how long will a lockdown take and when can they start to get back into their normal payment routines. New South Wales is expected to be in a lockdown for an extended period of time. I actually didn't see this morning's update. I know that the numbers were quite significant. However, I'm not sure if there was any update on how we're going to get out of this. So with that in mind, please do contact us. Sorry, that was a little bit premature there. I wanted to show you, of course, jump onto the CreditorWatch website. You can go to the blog and see a number of really good articles, but in particular, if you wanted to go to the extended business risk review, it will give you the ability to delve right into all the results. You can read the media release and start to get a better understanding of what is happening out there. There's a few comments from our chief economist as well, which is really good. So I do encourage you to jump in there. I believe a question. Oh, here we go. Some questions have come in. Can you send us the slides? Yes, certainly can send the slides. When do you see the administration market moving in the? Oh, sorry. Where do you see the administration market moving in the next 6 months? At what point do creditors, ATO, and banks in particular start to take action? I actually don't see them starting to take action in the next 6 months. I think the ATO in particular won't start. That's a combination of things. One, they can somewhat afford to support the business community out there, and they know that it's has a positive impact on the economy and on business growth. The other thing is we're in a potentially an election year, and the cynic in me suggests that they will hold off, getting back into their normal collection rhythms until after that happens. So I would suggest that'll be late this financial year that we'll start to see that. Do you foresee pressure on interest rates to climb a small degree, even though generally low compared to previous years? Look, I'm certainly not an economist, not an expert, but speaking to the likes of our chief economists and other experts within the field, they are certainly not expecting to see pressure on interest rates. Obviously, we saw that increase in inflation, but we've been below the sort of target band of inflation for quite an extended period of time. So they would actually like to see that move up. The fact that the RBA has come out multiple times and sort of doubled down on the fact that they won't be increasing rates. They don't do that flippantly. They don't necessarily politic. They are very, very much staying to their word, and the general consensus is they will stay to their word. Of course, no one can see into the future, and if there are significant changes that come out of the woodwork, then of course there could be pressure, but no expectation of changes to occur there. Questions: will you be tweaking any credit algorithms on the main CreditorWatch system due to the increased COVID restrictions? So our credit risk score and risk rating is a live rating. So we are taking in information on a daily basis, and that is certainly being taken into consideration by the data science and risk modeling team. So yes, regardless of the fact that we're in COVID and there's increased restrictions, that's how we operate on our credit risk score. It's being looked at a minimum on a monthly basis. So the fact that COVID's here doesn't necessarily make that any different. We're taking into consideration all of the data that's coming through on a regular basis. Do you believe government is aware of the hospitality supply chain and its impact on lockdowns? Look, I would be very surprised if they weren't aware. I think they're getting plenty of information coming in from the likes of the ATO and Treasury and whatnot. They've also got plenty of lobbyists that would be sending them information, showing them and telling them how much pressure certain industries are under. So yes, they would be very much aware of that. It's hard to obviously, I would imagine, provide specific industry-related stimulus or support. They're just relying on what is in place at the time. Question: given an increase in e-commerce traffic, do you Do you know what might be driving the high probability of default in the transport sector? Yeah, so I think something to think about with that. Good question there, and it's one that's come up a few times. Hold on a second. Afterpay, Zip, all of these buy now, pay later. Everyone's sitting at home buying things and getting home delivery. And to be honest, when I was setting up the camera, I had a whole bunch of packages that my wife had delivered. So I moved them out of the way, and you think, well, hold on, why is the transport sector struggling? The fact is, it's quite a large sector. So if you look at the ASIC code specifically, and then you start to look at the subsectors of that, some ones in there include obviously, travel by planes, trains, and buses, for example. So there's no one doing that. So there's a huge impact on the likes of Qantas and Virgin, for example. But then you also have things like couriers. There's not much being couriered within CBDs or between cities at the moment. Everyone's working from home. There's been this big shift away from paper-based signatures, for example, moving to electronic signatures. So that's certainly put a huge amount of pressure on. So yeah, I'd encourage you to, if you Google ANZIC, ANZSIC, you can have a look at the specific industries. And that industry that I showed is the top one, and then it breaks it down into multiple sub-industries. So pretty clearly you see some of those sub-industries that would be under a lot of pressure. Okay, I think that's all the questions for today. I will just go back here, prematurely close that. So thank you everyone for your time today. Hopefully you got something out of this. I would encourage you obviously to jump on the website and have a look at the additional content that we do have, such as the business risk review report, but also there's some other things in there around staff, financing, and whatnot. There's plenty of articles that we get up there. If you want to contribute an article or suggest an article, please do. Encourage you to do that. And if you'd like to speak with someone, please do contact us. There's a number there for you, an email, or you can jump online and there's a live chat box that will pop up and allow you to tell us what you'd like or what you'd want, and we can obviously jump for you. All right, perfect. Well, everyone, have a fantastic day. Hopefully it's lunchtime for most of you. I'm going to go and grab something to eat. Stay safe out there. Stay positive. We will get through this. We have started off a really nice base. We've just got to persevere for the next few months. All right, everyone. Thank you very much. All the best.